Dinar Shift, this is the update you'll want to absorb completely. Because for the first time in quite a while, the vital indicators surrounding Iraq's currency overhaul are aligning in a pattern that is becoming undeniably clear even for newcomers to this specialized field. Whether you've been tracking the Iraqi Dinar IQD conversation for years, or you've just begun investigating the mechanics of a potential revaluation, what follows is an essential analysis. We're cutting through the emotionally charged speculation and focusing only on the verifiable actions currently unfolding behind the scenes in 2025. It's natural for the community to feel overwhelmed by the sheer volume of online opinions, forecasts, and sensationalist narratives. The way to navigate this confusion is to deliberately ignore the emotional commentary and anchor your understanding only to the hard economic indicators, the official pronouncements from key Iraqi institutions, the broader global financial context, and the historical precedents set by other nations that have successfully reconstructed their financial systems following periods of significant instability. When you apply this filter, the narrative that emerges is not one of random, unpredictable events or instant, unforeseen currency miracles. Instead, it reveals a meticulously structured, phased process of monetary reform. This process closely mirrors the step-by-step sequences observed globally when a nation works to restore its financial credibility and strength. Stay with us as we systematically dissect each component of this established sequence, as all the information presented is calibrated to help you distinguish between the core, impactful developments concerning the IQD and the distracting background chatter, explaining why so many key factors are converging right now. Our analysis must start with the most concrete and foundational piece of information available, the confirmed exchange rates. Currently, the official rate set by the Central Bank of Iraq, CBI, remains fixed at 1,310 dinar for every $1. Concurrently, the informal or market exchange rate, which represents real-world transactions and was most recently reported, hovers around 1,390 dinar per dollar. While these figures may initially appear to be just simple data points, their relationship reveals a profound truth about Iraq's current standing on its path toward deep monetary transformation. The precise gap, or spread, between the official government rate and the street market rate is the clearest quantitative proof that Iraq has yet to secure the full international compliance necessary for global financial acceptance. This compliance is measured against a strict, universally applied metric known in financial circles as the 2% rule. This is not a negotiable target or a subjective prediction. It is a global standard. To be deemed a stable, functioning, and non-speculative market, a nation is required to maintain a consistently narrow variance, typically less than 2%, between its official currency rate and its market rate for a sustained period, often around 90 days or more. This strict adherence ensures that the currency's value is stable, that the domestic market is functioning freely and healthily, and critically, that the financial system is not being undermined by significant corruption, unauthorized money transfers, or heavy speculative manipulation. When the Iraqi dinar spread exceeds this essential 2% threshold, it is a clear, undeniable signal to international bodies that further internal, structural cleanup is mandatory before the currency can be fully recognized on the global stage and before any substantial revaluation or reinstatement could realistically take place. This is precisely the reason why experienced analysts and investors monitor the market exchange rate with such intensity. It serves as the most accurate, unfiltered barometer of Iraq's actual economic conditions and reflects the true world challenges that fundamentally determine the pace and feasibility of Iraq's monetary progress. Now, a frequent point of contention arises because new participants in this space encounter wildly varying online narratives about how close Iraq is to the decisive act of revaluation. Some voices proclaim that the nation is on the verge of the finish line, while others caution that extensive, arduous work remains unfinished. It is essential to understand the factual basis for these contrasting viewpoints to cut through the confusion effectively. The foundation for these differing estimates lies in what financial commentators refer to as the monetary reform checklist. This is not a single published document handed out by the Iraqi government. Rather, it is a collective concept. It represents the comprehensive aggregation of specific criteria, verifiable economic benchmarks, and distinct financial steps that must be demonstrably completed by any sovereign nation, aiming to achieve a more robust, internationally trusted, and recognized currency status. These mandatory steps are far-ranging and include dramatically improving banking sector oversight, fully conforming to established international regulatory standards, accumulating and maintaining substantial foreign currency reserves, achieving and holding exchange rate stability, successfully passing key financial and anti-corruption legislation, modernizing core payment systems, and ensuring verifiable cooperation and compliance with major global financial institutions. The current status of this conceptual checklist is mixed. Some elements have been fully executed, others are in a state of partial completion, and a few critical steps are still demonstrably works in progress. This varied state of affairs inevitably leads to a spectrum of professional interpretations. Therefore, when commentators assert that the revaluation is imminent, they are generally emphasizing that the majority of the structural and foundational reforms have been successfully put in place. Conversely, when others argue for a more prolonged timeline, they are correctly highlighting the persistent compliance deficits, the unpredictable nature of political transitions within the country, or the lingering challenges of enacting final, crucial financial laws. New investors must grasp that figures often cited online, such as 26% of people believing in imminent change versus 74% expecting a longer process, are not scientific measurements. They are simply interpretations of visible progress. This distinction is critical to maintaining a clear and realistic perspective. A central misunderstanding that frequently permeates online discussions concerns the introduction of lower currency denominations. Many people operate on the assumption that the printing and mass distribution of new, smaller notes must necessarily be the preparatory step immediately preceding a revaluation. However, sound economic logic, fully supported by the stated policies of Iraq's own central bank, dictates the opposite sequence. It is economically irrational to print and circulate smaller notes at a time when the existing currency still possesses extremely low purchasing power. The introduction of smaller denominations only becomes a pragmatic, necessary step after the value of the currency has undergone a significant increase. A nation releases new, lower denominations because its citizens need them for convenient, day-to-day commerce, not to satisfy a specific expectation of foreign investors. The correct, established economic sequence is perfectly straightforward. First, the value is raised. Second, the currency's purchasing power is stabilized. Third, the public is thoroughly educated about the forthcoming changes, and only then are the new denominations gradually and safely released into circulation. This precise sequencing is designed to prevent widespread confusion among the populace, mitigate significant risks of counterfeiting, and ensure that both businesses and ordinary citizens fully comprehend how the new, stronger financial system operates. Economic authorities consistently explain that raising the value is structurally the first major policy shift in the process, not the culminating final action. Understanding this logical, non-negotiable sequence illuminates how Iraq is proceeding intentionally through each structured stage of reform, carefully avoiding premature actions that could destabilize the entire economy. To grasp the potential trajectory of Iraq's currency, it is highly instructive to examine the historical framework of how nations worldwide restructure their currencies after prolonged periods of economic and political turbulence. Globally, the pattern of post-instability currency rebuilding is strikingly uniform. Whenever a nation seeks to reconstruct its financial identity after internal conflict, severe political upheaval, or systemic corruption, the central bank invariably executes a structured, multi-phased reform program. The initial phase is almost always dedicated to stabilizing inflation, aggressively building up foreign currency reserves, and systematically cleaning up the most problematic domestic financial institutions. The second, critical phase shifts focus toward restoring domestic and international confidence. This is achieved through wide-ranging regulatory overhauls, the establishment of robust international financial partnerships, and the complete modernization of the banking infrastructure. The third, final phase involves the strategic adjustment of the currency's value, the total overhaul of the financial infrastructure, and the meticulous preparation for global re-entry, particularly into vital systems like international foreign exchange, forex, markets. Over the last several years, Iraq's central bank has followed this global pattern almost exactly. Reserves have been dramatically strengthened, payment systems upgraded, major banks modernized, digital financial platforms introduced, and Iraq's financial systems are now being connected with multiple international frameworks. While acknowledged challenges persist, particularly concerning entrenched corruption and periodic political infighting, the overall strategic direction is clear. These steps are not random or isolated events, they are core components of a single coordinated long-term plan explicitly designed to elevate Iraq's financial status to one of parity with other major global economies. Recognizing this distinct, observable pattern is essential, as it allows observers to focus on the bigger picture of systemic reform rather than being distracted by the daily flow of unfounded rumors or sensationalist overnight predictions. This adherence to an established global playbook is itself a major clue. Crucial to the entire process of currency reform is the unwavering compliance with international standards. This is where the 2% exchange rate rule, strict adherence to global banking regulations, and implementation of IMF guidelines become absolutely non-negotiable. Many new observers incorrectly believe these standards are somehow flexible or optional. In reality, they are rigid requirements instituted to safeguard the global financial markets, prevent systemic manipulation, and ensure widespread financial stability. When a country fails to meet these essential standards, international bodies will systematically restrict its access to vital financial systems until the necessary corrections are verifiably made. Iraq has faced this reality, moving in and out of compliance multiple times in recent years, primarily due to issues like currency leakage, the persistence of unauthorized exchange markets, and interference from the political sphere. However, each time a compliance issue arises, the Central Bank of Iraq has responded with targeted, measurable actions designed to pull the nation back into alignment. These actions include significantly tightening oversight of currency auctions, actively reducing dependence on the US dollar for domestic commerce, aggressively promoting electronic payment solutions, and demanding greater transparency from private commercial banks. Although these steps may appear slow or perhaps repetitive, they are absolutely indispensable. A nation simply cannot reinstate or revalue its currency internationally if it is failing the most fundamental test of stability: a tight spread between its official and street rates. This explains the market rate's immense importance. It is the ultimate measure of whether the reforms are genuinely taking hold. Let's turn to one of the most vigorously debated subjects among those watching the IQD: the timeline for a possible revaluation or reinstatement. A highly logical argument frequently advanced by analysts is that any major systemic change to a nation's currency is typically implemented at the commencement of its fiscal year. The logic supporting this is compelling. Launching a new exchange rate at the beginning of a fiscal cycle allows the government to craft a much cleaner, more consistent national budget. It simultaneously prevents complex accounting disruptions, avoids major mid-year financial confusion, and provides businesses with adequate time to flawlessly adjust their financial planning and forecasts. While no one possesses the ability to claim an exact, specific date, a consistent historical pattern exists. Many nations that successfully restructured their currencies following financial instability implemented the change sometime between late December and early February. This particular window of time makes it significantly easier for governments to execute changes, accurately forecast revenue, and update all official financial records. Iraq has already shown a pronounced interest in aligning key aspects of its financial planning with the start of its official fiscal cycles. While this observation offers no guarantee of a specific action, it is a crucial pattern for new investors to understand and observe. The central takeaway here is that profound currency reform is almost never a random event. It is almost always meticulously synchronized with institutional demands, established financial calendars, and verifiable economic cycles, because this is the proven method for executing stable and lasting reform. A further factor that significantly bolsters this holistic picture is the heightened, purposeful activity occurring within Iraq's banking sector right now. Over the past year, the nation has dramatically expanded its physical gold reserves, deliberately cemented new financial partnerships with neighboring regional economies, and introduced cutting-edge systems explicitly designed to support and facilitate electronic payments and seamless international transfers. Furthermore, Iraq has strongly pushed for a radically more transparent banking environment, compelling private banks to achieve and maintain much higher global compliance standards. These improvements may sound merely technical, but they are critical determinants in assessing when the country is truly prepared for a stronger currency value. No nation can credibly raise the value of its currency without the necessary stable foundation to support it. Strong national reserves act as a vital buffer, protecting the currency against volatility. Modern electronic systems are essential to thwart fraud and corruption. International financial partnerships enable the currency to circulate more easily across borders, and transparency is the key to building and maintaining trust with global financial institutions. When these tangible, active steps are combined with Iraq's ongoing dedication to budget discipline and its pronounced focus on sustained economic growth, analysts gain a clear view. The foundation for revaluation is being deliberately and methodically constructed. The entire process is not about a sudden shock announcement, but about systematically strengthening the entire financial system until it is inherently stable enough to confidently sustain a new higher rate without undue external influence or pressure. A vital concept for new observers is understanding the clear delineation between political events and economic events. While political developments can certainly accelerate or impede the pace of reform, the currency's fundamental value is ultimately governed by unyielding factors like financial stability, demonstrable compliance, and verified international readiness. Some investors mistakenly believe that internal political strife or changes in leadership directly dictate the timing of the IQD's revaluation. However, monetary policy is explicitly designed to operate independently of the political cycle. Central banks worldwide are structured to function outside political whims, precisely because currency stability must remain absolute and consistent, even amid changes in government. Iraq has endured periods of intense political gridlock, cabinet shifts, and internal economic power struggles. Yet, throughout these challenges, the Central Bank of Iraq has consistently continued to implement its core reforms, unaffected by the political noise. This unwavering perseverance is a powerful clue in the larger tapestry. When a central bank maintains its commitment to modernizing systems, upgrading banking infrastructure, and strictly enforcing international standards despite the political landscape, it signals an unshakable determination to achieve its long-term financial objectives. Understanding this fundamental separation helps investors avoid knee-jerk, emotional reactions to political headlines. The focus must remain on the financial indicators that possess the actual power to influence currency value, and those indicators currently point to gradual, yet consistent improvement. A major and pervasive misconception circulating in the community is the belief that a revaluation will occur suddenly, with zero visible progress or preparatory steps beforehand. But monetary policy is not a spontaneous lottery win. Sovereign nations do not simply wake up and decide to elevate their currency value without having first completed all the necessary technical, legal, and complex financial groundwork. Before any major revaluation is finalized, there are always unmistakable signs. The exchange rate stability tightens. The market spread shrinks dramatically. Banking systems become fully digitized and operational. Government budgets are demonstrably aligned with the newly articulated financial strategies. Furthermore, public communication and educational materials are increased significantly, and, crucially, new notes are printed and secured in preparation, though they are not released until the precise appropriate moment. These preparatory steps are time-consuming and can span many months or even years, depending on the complexity of the national reform required. Iraq has already systematically completed several of these foundational steps, and the remaining necessary actions are becoming increasingly visible as the country meticulously adjusts its banking and economic operations. This inherently structured approach is the very reason why so many experienced observers believe the timeline is definitively narrowing. The verifiable clues indicate movement, not instantaneous movement, but a steady, intentional progression that precisely mirrors the revaluation patterns observed in other successful nations. For investors, recognizing and accepting this sequential progression grounds expectations in real-world economic behavior, not unsubstantiated rumor. Let us also confront another deeply ingrained and widespread belief: the myth that powerful foreign governments possess direct control over Iraq's revaluation decision. This notion has been repeated for years, but it misunderstands the fundamental architecture of international finance. No external country has the legal or financial authority to dictate the exchange rate of another sovereign nation. What foreign governments do influence are compliance benchmarks, sanctions regimes, trade relationships, and a nation's access to specific global financial networks. They cannot, however, force Iraq to alter its currency value. Their power lies in the ability to restrict or permit the use of economic tools that Iraq requires to participate robustly in global markets. This means that the true, ultimate control rests entirely with Iraq's own central bank, its domestic economic policies, and its capacity for internal stability. Understanding this distinction is vital, as it prevents observers from unfairly blaming external forces when the pace of progress appears slow. The speed of the reform is a function of Iraq's internal ability to meet global standards, rigorously implement complex financial laws, dramatically reduce corruption, and thoroughly modernize its entire banking sector. These are domestic challenges, not primarily international blockades. As Iraq fortifies these internal mechanisms, external restrictions naturally recede, and the path toward a stronger currency becomes visibly clearer and more direct. This internal strengthening is the core progress happening today. Another indispensable component of this complex financial puzzle is the strength of Iraq's national reserves. Reserves are the bedrock of any successful currency reform. They shield a nation against extreme volatility, actively support its exchange rate, and inject critical confidence into international markets. Iraq has aggressively and significantly increased its foreign currency reserves, and continues to methodically accumulate physical gold, which is universally regarded as one of the most stable and safest assets a nation can hold. Strong reserves are absolutely mandatory for any country contemplating a revaluation because they guarantee the central bank can confidently support the new rate and defend it against potential speculative attacks. Iraq's consciously increasing reserves are a strong signal that the nation is strategically preparing for future steps, acting with measured strategy, not impulse. Furthermore, Iraq has maintained a commendably low inflation rate, which is another critical prerequisite for successful currency reform. A country cannot sustainably strengthen its currency if inflation is spiraling out of control. Low inflation confirms that the currency's internal purchasing power is stable enough to support a substantially higher international rate. The combination of burgeoning reserves and low inflation paints a strong, positive picture for Iraq's long-term economic prospects, signaling discipline, readiness, and a profound commitment to enduring prosperity, all non-negotiable elements for a successful revaluation. Now, let's explore the fundamental role of laws and comprehensive economic reforms. Many people seriously underestimate the profound importance of legal frameworks in dictating currency value. Over the past few years, Iraq has systematically introduced and refined several key economic statutes, including financial management laws, modernized investment laws, broad banking sector reforms, and new regulatory frameworks designed to align the nation with global standards. However, the mere act of passing laws is only half the effort. The true, demanding challenge lies in the effective implementation of these laws. Effective implementation requires rigorous enforcement, verifiable compliance, continuous monitoring, radical transparency, and seamless cooperation across all government agencies. Iraq has made demonstrable, noticeable advances in these areas, but more work is still required, particularly in the ongoing fight against deep-seated corruption and in solidifying the rule of law. Without the proper rigorous implementation, even the most impeccably written laws cannot support a stable and trustworthy financial system. Conversely, with effective implementation, these laws become powerful, magnetic tools that attract significant foreign investment, fuel sustainable domestic growth, stabilize the broader economy, and, crucially, strengthen the national currency. Investors should be intently focused on how Iraq proceeds with the application of these reforms. Each step forward is a new clue indicating readiness for a future where the Iraqi dinar can operate with confidence, far beyond its borders. As we move deeper into this analysis, it is vital to remember that profound economic reform is never an isolated action. Iraq's currency reform is inextricably linked to its much broader national economic strategy. This strategy encompasses ambitious goals such as expanding oil production capacity, actively diversifying revenue sources away from oil, solidifying beneficial trade agreements, and vigorously supporting the growth of the private business sector. While oil remains the country's single largest source of revenue, Iraq is actively, purposefully working to reduce its singular dependence on it. By substantially strengthening its non-oil sectors, Iraq is constructing a more resilient, balanced economy, which by definition supports a stronger, more stable national currency. Economic diversification also acts as a powerful magnet, attracting more foreign investment, generating new job opportunities, and ensuring more stable government budgets. These broader, systemic economic improvements create the ideal environment where a currency revaluation becomes truly sustainable. A currency simply cannot maintain strength unless the underlying economy supporting it is also strong and diversified. This is why analysts study both financial sector reforms and wider economic development indicators. When both move synchronously in a positive direction, it signals a deeper, more permanent transformation. Iraq is exhibiting clear signs of building a robust foundation for its long-term financial future. One of the most powerful and clearest signs of demonstrable progress stems from the comprehensive modernization of Iraq's banking systems. Over the last few years, Iraq has been systematically migrating from a deeply cash-heavy society toward a more digital, transparent financial environment. The successful introduction of electronic payment systems, global standard international banking platforms, and greatly improved digital governance has made it dramatically easier for both citizens and businesses to manage their finances securely and efficiently. This profound shift is critical because a modern digital banking system sharply reduces fraud, inherently increases transparency, and strengthens government oversight capacity. It also effectively aligns Iraq with global financial standards, allowing for smoother international transactions and decreasing the nation's heavy reliance on the US dollar. These systemic, though technical improvements have an immense impact on the ultimate currency value. A strong digital infrastructure provides the central bank with greater control, enhances financial stability, and meticulously prepares the country for full integration into highly sophisticated international markets. Examining other countries that have successfully restructured their currencies reveals that digital modernization was always a key non-negotiable component. Iraq is diligently following this proven template, and it strongly indicates that the country is laying the essential foundation for a future where the dinar is both stronger and internationally recognized. Another intriguing clue in Iraq's complex reform narrative is the purposeful focus on reducing dependency on the US dollar. For many years, Iraq's economy relied significantly on the dollar for trade settlement, daily transactions, and virtually all international payments. This extreme reliance created serious vulnerabilities, exposing Iraq to external pressures and severely limiting its monetary independence. Over the past year, Iraq has taken several targeted measures to lessen this dependency. These steps include actively encouraging the use of the local currency for all domestic transactions, strengthening trade ties with neighboring countries to facilitate dinar-based commerce, and expanding the nation's capacity to utilize alternative currencies in major international deals. The aim of reducing dollar dependency is not to reject the dollar, but rather to assert greater control over Iraq's own currency destiny. When a nation is excessively dependent on another country's currency, it becomes exceedingly difficult to stabilize its own exchange rate. By systematically reducing dollar reliance, Iraq is strategically constructing the foundation for a more independent and therefore more stable dinar. This fundamental shift is a powerful signal that the central bank is preparing for future steps that will require greater and more assertive monetary control. We must address the crucial importance of public education within the currency reform process. Before any major currency change, whether it involves new denominations, increased value, or updated policies, governments are universally expected to launch comprehensive, sustained information campaigns to prepare the general public. These campaigns encompass official statements, media interviews with financial leaders, the dissemination of educational materials, and clear, plain language explanations of how the new financial system will function. Iraq has already issued multiple official statements over the years explaining various components of its monetary reform strategy. These public communications are deliberate. They are part of a long-term, coordinated effort to inform citizens, build essential public trust, and ensure that changes are fully understood and accepted. When a currency reform or revaluation is executed without proper public education, the result is mass confusion and potential economic disruption. Conversely, when a government takes the necessary time to educate its people, the transition is significantly smoother and more successful. The fact that Iraq continues to issue official explanations regarding purchasing power, exchange rate stability, and its future financial steps is a key clue that the groundwork for reform is being meticulously laid. Public education is traditionally one of the final, decisive steps before a major policy shift, and Iraq's increasing communication is a powerful sign that progress is actively and intentionally being shaped. A critical aspect of the entire revaluation conversation involves the concept of purchasing power. Raising a currency's value is not merely about improving international exchange rates, it fundamentally means increasing how much the currency can buy domally. When a nation successfully strengthens its purchasing power, its citizens can purchase more goods and services with the same amount of currency. Prices stabilize, domestic economic growth is stimulated, and public confidence increases. Iraq has repeatedly and explicitly stated that a core tenet of its monetary reform strategy is the substantial improvement of its citizens' purchasing power. This is a vital signal because it confirms that the reform is not solely focused on the global financial markets, but is also aimed at improving the everyday lives of Iraqi citizens. A stronger currency benefits families, businesses, and the government, reducing inflationary pressures and fundamentally improving economic stability. This focus on domestic purchasing power aligns perfectly with global precedents set by other nations that successfully restructured their currencies. It signifies that Iraq is not merely pursuing an international exchange rate, but is working to construct a stable and prosperous domestic economy that is capable of confidently supporting that stronger rate when the time comes. This balanced, dual-focus approach is a major indicator of long-term sustainability and success. Another significant clue that observers should be keenly aware of is the structured, methodical pace at which Iraq is implementing its entire reform agenda. Some countries have rushed currency changes, only to be plagued by subsequent instability. Iraq, by contrast, is adopting a slow, painstaking approach. While this deliberate speed may frustrate some investors hoping for instant gratification, It is actually a sign of the utmost seriousness and diligence. A slow reform process inherently reduces financial risks. It prevents sudden economic shocks. It allows the central bank ample time to meticulously evaluate each step and adjust its policies as necessary. A sudden, poorly planned revaluation could severely damage the economy, confuse the populace, and invite rapid speculation. But a structured, deeply deliberate reform process creates lasting stability and ensures that once the currency is strengthened, that strength is maintained. When you analyze Iraq's step-by-step progress, the reserves, the compliance efforts, the banking modernization, the digital systems, the reduced dollar reliance, and the public education, you observe a consistent, deliberate rhythm. This rhythm is not accidental. It is the observable cadence of a country preparing for a complete major financial transformation. The visible clues are not isolated events. They are interconnected, and together they paint an increasingly clear picture of Iraq's destination. One of the most helpful ways to fully comprehend Iraq's progress is to draw parallels with other nations that have undergone similar transformations. Countries such as Kuwait, South Korea, and Germany have all experienced profound currency instability before successfully rebuilding into more powerful, modern economies. In nearly every instance, the process unfolded in predictable, proven stages: stabilize, modernize, strengthen, and then revalue or reinstate. Iraq is currently navigating these exact same stages. Economic rebuilding is never a perfectly linear process. Delays, setbacks, and unforeseen challenges are inevitable. But it is the overall, long-term trend that holds the most significance. Iraq's financial trajectory today is demonstrably stronger than it was 5 or 10 years ago. The banking sector is more technologically advanced. The national reserves are significantly higher. Inflation is lower. Digital financial platforms are constantly improving. International relationships are expanding. And, critically, the nation's long-term financial strategy is progressively aligning with established global standards. These are the precise ingredients that all other successful nations had in place before their currencies entered a new phase of strength. Understanding this powerful historical context helps observers see that Iraq is not an anomaly. It is methodically following a known and proven economic path that has historically led to stronger currency outcomes. Let's synthesize all of these clues into one complete, focused picture. We have a confirmed official rate of 1,310, a market rate of 1,390, and a spread that is actively being narrowed for the sake of international compliance. We have a central bank that is aggressively modernizing all its systems, accumulating gold reserves, digitizing payments, and forcefully demanding greater transparency. We have a government that is refining its budget process, implementing new financial laws, and working towards long-term, verifiable economic stability. We see a growing stated focus on improving domestic purchasing power, a measurable reduction in dependency on foreign currencies, and significantly improved international partnerships. Finally, we observe ongoing public education, communication from key financial leaders, and relentless structural economic advancements. When these individual pieces are viewed collectively, they do not constitute a mystery, they create a detailed roadmap. This roadmap clearly shows Iraq moving purposefully toward a financial environment that is fully capable of supporting a substantially stronger currency. The situation is not about speculating on dates or waiting for a surprise event. It is about soberly observing the measurable progress that is occurring month after month. Investors who focus their attention on the verifiable indicators rather than the surrounding noise are capable of seeing this profound transformation clearly. And those indicators signal unambiguous movement in the desired direction. As we conclude this deep dive, take this point to heart. The Iraqi Dinar Revaluation is not an event driven by rumor. It is not a mystery to be solved, and it will not be a sudden, unearned miracle. It is a structured, predictable financial process that follows the exact same logical steps other countries have successfully executed during major monetary reforms. The clues are not concealed. They are visible to any careful observer. The critical indicators: exchange, rate stability, full compliance with international standards, high reserves, modern banking, digital systems, improved laws, reduced corruption, enhanced transparency, and gradual public preparation, are the precise ingredients required for a successful, sustainable currency transition. Right now, Iraq is meticulously aligning these ingredients one by one. While the entire process has not yet reached its final conclusion, the overall strategic direction is entirely unmistakable. For newcomers to this specialized space, the single most important action you can take is to stay informed, remain realistic, and maintain an unwavering focus on the factors that genuinely influence currency value. Tune out the excessive noise, diligently monitor the verifiable indicators, fully understand the underlying strategy, and recognize that every single step Iraq is taking today is a deliberate part of a larger plan to fundamentally rebuild its financial future. The clues are converging, the timeline is becoming clearer, and the structural foundation for a stronger Iraqi dinar is being shaped right now in real time. Stay tuned, exercise patience, and remain grounded, because this significant financial story is still actively unfolding.